Okay, in this episode, we're going to talk about some of the more popular investment research and our original investing commentary and podcast on the Validea Guru Investor blog for the week of May 7th, 2021. And to start, I will, I guess, start out with an article that I wrote, and the title of the article was Moves to Consider to Help Protect Your Portfolio and Profits. And the idea for this article came because I have been having conversations around sort of being in the market or putting money to work in the market with people I'm speaking with, investors I'm talking to. And so I was trying to just ask the question of, how might an investor today, given how far back stocks have come and, certain segments of the market are up tremendously this year, what an investor might be able to do to their portfolio to help maybe mitigate some of the downside risk in the market, or basically make some changes around the edges that might help protect one's portfolio a little bit more in the event of a big market downturn. And so just real quick, and I won't go into the details on all of these, but I kind of identified a couple, things that an investor could do. You could actively rebalance your portfolio and maybe move and get more diversification, particularly in some of the parts of the market that haven't done well. It's been a great decade for U.S. stocks. It's been a horrible decade for commodities. International stocks have underperformed. So there are asset classes and places in the market that investors can get exposure to try to get a little bit more diversification and try to maybe lighten up on some of the places that have done really well. Related to that, I sort of talked about how one of the things we've been seeing, and we've talked about this previously, is how low quality stocks in the value category have dramatically outperformed high quality stocks. So if you're a value investor and you have the ability to kind of look, at your portfolio and try to tilt maybe more towards where there might be a little bit more value, I was kind of making the argument that, high quality value stocks, there might be an opportunity there. I talked about hedging and buffering, and there's different ETFs on the market that basically do allow investors to make a little bit more of a direct bet. Like if you're worried about, the market going down, there's tail risk ETFs. There's also ETFs that sort of offer protection against a certain amount of loss, but cap the upside. So those might be important or viable options for investors looking to protect their portfolio a little bit. And then the last part was around timing. And here I was talking about probably for a lot of investors that have taxable money at work, they're probably going to be hitting with stocks they bought last year if they were buying during the, during that sell-off, which a lot of investors weren't, but some were, maybe you'd be hitting the long-term capital gains rate on some of those positions. So maybe it's time to lighten up on the areas in your portfolio where you have the weakest conviction. And then I was just kind of talking about required minimum distributions too, with people that have IRAs, that it might make sense, to more aggressively pull those RMDs now with the market at elevated levels versus kind of waiting until the end of the year, because there's a chance the market could go up, there's a chance it could go down, but just kind of taking those RMDs now. But that kind of relates to just in summary, all of these decisions, they all would have some, implication. They may not, you may make these decisions and they could actually detract from an investor's return. So I was just kind of, pointing out that these are things that investors might consider if they're worried about the market's level and the pullback. But at the same time, it's not like these decisions wouldn't come with their own set of risks as well. So.
Yeah, this gets at the concept of, managing money like in an academic world versus managing money in the real world. And, in an academic world, you would say, all right, what you should be doing to your portfolio now is absolutely nothing, because, you've got your long-term strategy set up, other than what you talked about at the beginning, which is, obviously if your stocks have gotten, way out of whack relative to your bonds or something like that, you want to rebalance back. But in an academic world, you just stay the course and you don't do anything. But in the real world, people tend to panic and people tend to be worried. When you have this kind of gains in a year, people tend to want to do something to protect them. And so in the real world, what you want to do is you want to do things around the edges versus the binary choice, because what really gets you in the real world is the binary choice. So if you say, all right, the stock market has run up so much, we're at all-time highs, I've got these huge gains, just put the whole thing in cash or something like that. That's really what gets you in the real world. And so you introduce some great ideas in the article in terms of what you can do around the edges, where you can maybe make some minor adjustments in your portfolio that might prevent you from making the binary choice. Because in theory, markets at all-time highs are actually a good time to invest. Markets that are at all-time highs tend to continue to do well. And so although it's our natural reaction to think, all right, I got to do something to protect myself because I've got these big gains. The data doesn't show that, but making changes around the edges can definitely be a good thing because it can avoid, making major mistakes.
Thank you. I'm glad you liked my article. What was our podcast this week?
We talked about some potential metrics to limit value traps. And so we're talking about the idea that whenever you run a value strategy, you're investing in companies that are out of favor. And when you invest in companies that are out of favor, some of those companies are going to go on to do well because the market has overestimated how bad things are. That's why value works. But then another group of those companies is going to tend to have a situation that's much worse than what the market is thinking. And so those are effectively your value traps. So they look like values in the surface based on your standard metrics, but there's actually major problems behind the scenes and you don't want to invest in them. And so anybody who runs a value strategy, whether it's a quantitative value strategy like we do or just a discretionary value strategy, you want to try to avoid those types of companies. You want to get the benefits of the value strategy without these terrible companies that go on to have problems or go on to go bankrupt. But in the real world, that's very, very difficult to do because anything you do to try to limit those companies that end up being value traps might also limit the companies that end up being good investments. And so we talked about, in the article, I talked about the idea that around the edges, you probably can do some things to limit value traps and improve your value strategy, but you have to have the expectation that what I'm doing is I'm making slight improvements to what I'm doing. I'm not going to, double the return of my value strategy and just cut out all the value traps. That's not possible. And so we talked about in the article some of the metrics, or in the podcast, sorry, and some of the metrics we use to try to do that. And so, for instance, an example would be if analyst estimates for the future for a company are way, way, way below what happened in the past, then something is going on with that company, obviously with their business, that leads to a situation in the future that's much worse than what we've seen in the past. And so what we'll do with our system is we have a variety of metrics like that. We'll rank all stocks based on those metrics, and then we'll combine those metrics together and take the absolute worst companies out. And so before we apply our value models, we'll have those absolute worst companies eliminated. And we found that around the edges, that can slightly improve the performance of a value strategy. What was your favorite article from the blog this week?
It was basically from Royce Investment Partners, and it was an article about small cap stocks. And by the way, we don't always, most of the highlights we do and the curation we do is from media related sources, but there's plenty of great research that comes out of these, big investment management companies. And Royce Investment Partners is known for sort of small cap investing. And so they basically were looking at the performance of small cap stocks. I mean, it was a blowout quarter for small caps, especially micro caps. Small caps did good, but micro caps were up. The Russell microcap index was up 24% versus 2.8% for the NASDAQ. So it just goes to show how much it outperformed. And it's actually consistent with, coming off of these troughs and coming out of these really sort of bad markets, which small caps have been doing better before just this quarter, but this quarter was really where you saw significant outperformance. But coming out of recessions early in a cycle is when small caps do tend to typically, historically, outperform. But they also pointed out that within the high quality small cap space, many of those stocks haven't done nearly as well. So that might be an opportunity in terms of high quality small cap investing. And then what they also showed in this piece was that after when small caps performed best, like historically over periods of time, the outperformance, the annualized 3-year performance for small caps has been very, very good. So what that implies, if you're using history as any guide, that the really strong performance we've seen out of small caps actually signals that small caps are probably going to produce what they said is low double-digit returns on an annualized basis over the next 3 years. So I think that bodes well for people that are investing in small caps and have exposure to that area of the market.
Yeah, we all have this tendency to say, we've got this big run and whatever it is, small caps or whatever it is, and so it's got to come to an end. And that what they're saying is sort of the opposite of that. When you get these runs, they can be clustered together and it can actually bode well for the future. So the fact that we've had this big run up in small caps may not mean now is the time to get out of small caps. It actually might bode well for like a future longer run in small caps.
Yeah, absolutely. What was the article that stuck out to you this week?
So this is a big pet peeve of mine. This whole thing, I don't know if has there ever been a period in our career where there hasn't been a lot of cash on the sidelines? if you listen to the media, there's always this cash sitting on the sidelines that's about to come into the market. It's always in some way predictive of, where the market's going to go in the future. So Barry Ritholtz had a really good article in Bloomberg where he tried to look at the facts of this. And I'll read a quote from the article. But so basically what he said is the breathless thesis by some that trillions of dollars sitting idly in brokerage accounts is just waiting to be put to work in the market fails to stand up under scrutiny, says Ritholtz. He argues there's always cash in the sidelines. It is neither a leading nor lagging indicator. And so I think that's the point here is, people love to say, all right, this cash, use these metrics to say this cash is sitting on the sidelines, or, Warren Buffett is sitting on lots of cash. And there's all these ways people try to use the idea of cash to say, here's how I can time the market based on what's going on with cash in general or some specific investors' cash. And, I think the reality is that just doesn't stand up to scrutiny. The reality is, cash on the sidelines probably tells you very little about how you should implement an investment strategy.
Yeah, and I think there's a difference between what people have in their bank accounts and people that have pulled money maybe out of the market in their brokerage accounts. I do think, if you look at periods when there's a lot of stress or, risk or volatility in the market, clearly you have money moving out of stocks and going into cash in other places. And I think that happened during the depths of the pandemic. Maybe some might look at that and say that's kind of a good contrarian indicator, but your point is well taken. There's always this idea that there's all this cash on the sideline. It's going to come back in. It's going to drive the market higher. And it's just, I think Ritholtz pointed out some good stuff in this piece. So that was good.
Yeah, absolutely. And also the idea of, he talked about the idea of the money supply. A lot of people have been using the concept of the M1 money supply, which is up a lot right now, based on what's going on in the pandemic, as some sort of having some sort of predictive value. But he explained, that behind the scenes, there was a technical rule change that, savings accounts are now in there. And so it's important just to understand whenever you see any of these cash metrics, what am I actually seeing? And am I seeing an apples to apples comparison with what I've seen in the past?
All right, we'll put links to all these in the show notes. Thank you guys for listening, and we'll see you next time.
Thank you.
Justin Carbonneau and Jack Forehand are principals at Validea Capital Management. The opinions expressed in this podcast do not necessarily reflect the opinions of Validea Capital. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validea Capital.